Let's get in the management of Transport Corp of India, Vineet Agarwal, who's the MD, who joins in after what was a fairly steady quarter. I mean, you had a 7.5% revenue growth, 8% EBITDA growth, and margins were pretty, stable at that 10.5% mark as well. Thanks a lot, Mr. Agarwal, for joining in. First half, your revenue was up 8%. When we started the year and after the first quarter, your annual guidance was 10 to 12%. Second half, seasonally and, is usually stronger. So even if you up your growth rate, I just wanted to understand whether you end this year with 10% growth or 12% revenue growth, because the first half has been 8%.
Yeah. Hi, Mangalam. It's the second half is always the best two quarters of the year for us. Also, I think December end is when MNCs are closing their books, and March end is when Indian companies are closing their books. So there's always a thrust towards more sales and more push towards volumes. So we do expect that this will pick up. And, the range is 10 to 12% because there is a lot of changes that keep coming up from whether it is from a macro perspective or a micro perspective. When GST was announced, the changes in GST was announced, the flip that happened in the end of September was huge. So that and going on in till Diwali, things were quite hot in terms of movements. But some of this has to keep playing out for the volumes to come up. So I cannot give you exactly whether it's 10 or 12%, but definitely in that range is where we should end for the year. That's on the top line. On the bottom line, we are looking at the same numbers also. So there's no change in our projections.
Right. Mr. Agarwal, good morning. This is Vinny joining in the conversation. Just want to understand your LTL as well as FTL mix. What is that in Q2, given that LTL normally is higher margin? So just want to understand that.
Yes, in our freight business, we have two areas that we work in. One is the full truckload, which is essentially a full truck moving from one customer to the other. The other is less than truckload, which essentially is moving smaller packages, whether it is essentially but a higher dimension. So it is not very small express kind of packages, but larger, maybe 300 kilos, 500 kilos, or some things like that. That move through a hub and spoke system, not necessarily direct from customer's doorstep to the other customer's doorstep. So these are two businesses. The LTL business is typically double the margin, operating margin of a FTL business. And it is a business of network. So if you have branches, which is what we have, about close to 750 branches in the freight business, that helps us to generate more volume across the system. There are also customers who give both kind of volumes, but more on the MSMEs is that generate the LTL business.
So what we wanted to understand is how much was LTL as a composition of your overall business? Because I remember at the end of the first quarter, it was close to 36%. You had expected it to be 50% by the end of this year. All of this would mean that your margins would be positively impacted. So where did that number stand and where are you on those projections?
The 50% was not end of this year, but end of FY'27.
Okay.
Because it's a slow and steady growth. We have moved from 36% to 38%. And our end of year FY'26 goal is to get to about 42%, and then shift to 50% over the next year and a half from now. So yes, and that will definitely impact the freight business margins positively. Right now, the sentiments have improved quite a lot because of the GST impact, but it has to still translate to business for MSMEs.
Okay, still has to translate. So right now the number is what? 42% will be by the end of FY'26, right?
That's correct.
Okay. And right now is currently what's the contribution?
38%.
38%. Okay. And what about your Seaway margins, right? That has suddenly seen a very good spike up. 37%, I believe. 37.5% is the EBIT margins this time. So what has led to that, given that your target was somewhere between 28 to 29%? What has led to this amazing margins? And do you think this is sustainable through the rest of the year?
The Seaways business continues to surprise us. We had one ship that went for, out of the 6 ships that we own, one ship went for a dry dock, and hence we had lesser voyages also. But the bunker prices, which is the fuel prices, actually came down, and that helped us to get better margins. The freight rates we operate only on the domestic sector on the East Coast as well as the West Coast. And the freight rates are stable. They have not really gone down too much or gone up. But the fuel prices have come down. So that has helped us in terms of margins. We've also been trying to push more volume through the system. Of course, there's a limitation in terms of capacity. We run at full capacity and all our ships are operational. So yes, and also all our ships are depreciated. They are old, but they are all depreciated. You also must be aware that we have placed an order for two brand new ships that are going to come in next year and add to our capacity.
So, do you have any early projections for next year when it comes to margins and overall revenue growth?
Not yet, because these ships will come maybe about a year from now, September, October, and they are not of. They are about 7,500 deadweight ton each. And once they are delivered, then we'll start the operation. So it'll take 2-3 months for them to stabilize. So it is the reflection of some of that will come only in FY27, maybe towards the end of FY27.
Got that point. Thank you, Vineet, for joining in. Wish you good luck for the second half of this year, which promises to be a lot better than the first half seasonally. And, 10 to 12% revenue and profit growth is what we are guiding for. Obviously, for another conversation when we'll talk about all the other parts of your business, including the likes of cold chain, etc.